Good evening. It's Peter Klein, Chief Investment Officer, co-founder, ALINE Wealth, with you this day of the 23rd of August, right before the start of the Fed's confab in Jackson Hole, Wyoming, the annual event where the academics get around and the Fed and different economists speak about the markets and, of course, the economy. So we'll see what Friday afternoon brings when we hear from Chairman Powell. The guess, of course, is sort of right down the middle, not too hawkish and not too dovish, probably very data dependent. Expect those types of terms from Jay Powell as we continue to go through this inflationary period. I have some slides to share with you that give you a sense on what we're thinking, how we're thinking, and allow me to share those slides with you now. So where are we now? I want to remind you folks that in March of this year, an early part of, March of 2023, just 4 months ago, 5 months ago, the S&P 500 was flat for the year. We had a strong January, a weak February, and here we are in the first week of March, and we're flat for the year. Rumblings begin about bank failures. And indeed, we had 3 of them, big banks that failed. Equity loss, gone. People freaking out. I had clients calling and trying to figure out where they're going to put their money in banks, and they have too much in one bank and the FDIC limits. That's what we were involved in just a few months ago. That's not an everyday occurrence, bank failures. The Fed was nervous. They reversed course from being restrictive, and stimulus was ended back into the foray, right? They used the term funding limits, their facilities rather, and they used that to inject stimulus. At the same time, we had the debt ceiling debate, and because of it, the Treasury Department was unable to issue new bonds, which is typically restrictive, right? And so because they were unable to do that, in essence, it was stimulative. Now that those two, 1-2 punch, if you will, on monetary as well as fiscal, I guess was enough stimulus to bring the market up and add into it, sprinkle into it some AI exposure and some excitement there. And here we are in August, and we're up, 14, 15%. We were up higher. We've come down a bit. So the banking crisis that was the spark to bring in the stimulus is now behind us. The debt ceiling is behind us, and indeed, the Treasury has been issuing bond after bond to finance the $32 trillion of debt we have. So I guess what I'm trying to say is what brought us out of this is back. We reversed it now. We're back to the restrictive policies that we had prior to the banking crisis. And yet, we're still up 15% or so. This was and 20 times forward. All right, so that was the sort of setup. Now I want to go into some of the details with respect to the economics. First, inflation. As you know, we've been saying for some time that inflation is sticky, that it will not be vanquished so easily. This chart shows that. It shows how in the 70s, 40s, and 1910s, previous inflationary periods, you had the spike, it came in, and right back up it went, 3 for 3. So this is what we expect to see again. And here again, you're seeing a very similar kind of pattern. So don't think because we're coming down here that it's over. It's not. In our view, inflation is going to be around for a bit to come. And primarily due to, and we've talked about this, the deglobalization and reshoring efforts. We've spoken about the union power of labor today is so much stronger. And of course, it's the net zero movement that is also very expensive, as we do not have the supply of copper, aluminum, and other minerals that we need to usher in electrification and net zero. So expect inflation to remain somewhat sticky. The other side of that, of course, is interest rates. And here we're talking about when the Fed finishes its tightening. So now they've said, assume they say this, I tend to think it's going to be later this year than earlier, but perhaps even early next year, where they say, okay, we're pausing, we're done. That does not give us an all clear signal on the stock market. In fact, if inflation is still elevated, that was the previous slide, and that's our base case, even with the Fed saying pause, look at the returns historically that occurred. So it's not necessarily the interest rate saying pause that's going to give us this kind of situation. And if inflation is not elevated, which is not the case, then you could see some green shoots. Here's the 10-year yield. We've seen it pop above 430 now. We think it looks like it's going higher. Watch this. Very important to watch this. Watch how interest rates behave. If you start seeing 4.5, 4.75, that's going to have some impact. And of course, here's the alligator jaws that we always, worry about, right? Look at the correlation. Again, this is a chart that shows you the S&P forward here, so higher forward, right? And then here's the reverse. This is the real 10-year bond. This is unusual. This alligator jaw formation is unusual. Usually, when you're seeing higher real rates, you see lower forward multiples. Here, you're seeing higher multiples despite higher real rates. And so this is something's got to give. Something's got to give here. Beware of when those jaws close. We've seen a fair amount of recession-ish data coming out. Here's new delinquent balances by loan type. You're seeing it's picking up. Here's the leading economic indicators. Never before have you seen a period where leading economic indicators are negative and we don't go into a recession, much like the often quoted inverted yield curve indicator. This is the consumer essentially. I used the hotel data and look at the growth, right? So consumers are spending. So the question that's asked as we enter the new sort of the fall of this year is, do we need to have a market event to impact wealth in order to tame inflation? In other words, is inflation essentially a byproduct of growth in assets and spending and consumer behavior? And it very well may be. Maybe it's tied to the wealth effect. And if that's the case, then they have to you have to have the wealth effect get hit in order to see inflation get under control. We'll see. All right. Now some market technicals, if you will. This is the sum of the 5 largest companies in the S&P 500 and their weight in the S&P. This is real important stuff. So when you see, and previously it was a much lower figures. We're at 24% now. This is 5 out of 500. That's 1% of the index, 24% of the weight. Folks, that's a red flag. We crossed out the names of this because of compliance reasons, but essentially you probably could figure out which these companies are. But they're the darlings of 2000, right? These are the companies that everyone wanted a piece of, and yet it took them. This one never got back to break even. Look at the number of years it took these iconic, wonderful, great companies, still today, great companies that are still down substantially from its 2000 high. What do I mean by this? This tells you that you could have a great company, but an overpriced stock. Remember, we're not buying the whole company. We're buying a share of stock in the company. So you have to be mindful of the valuation of those shares. Does it make sense? Don't get so focused on just the company. Think about the individual shares that you're buying of that company. This speaks to how many stocks in the S&P 500 are outperforming, and it's at an almost all-time low, except for back in 1999, 2000. So this tells you just a handful are outperforming. Talking about valuations, and we always, we're a valuation shop here, so we're very mindful of that. Here's the Magnificent Seven, it's known as, right? Here you go, 2.5% free cash flow yield. The rest of the S&P, 5.1 free cash flow yield. Okay, free cash flow yield is probably the best measure of a true valuation of a company. You take essentially the net income, you take cash flow rather, and you strip out the required spending that's necessary to continue to grow your company, and the resulting figure is free cash flow, the lifeblood of a business. And when you compare that to the valuation of the company, you get something called a free cash flow yield. This down here shows you the differences over time. And what you could see here is that the S&P 500 is, as of January 2017, had a free cash flow yield of 5.3%, and in June of 23 had a 4.5% free cash flow yield. And of course, the expensive mega caps had, you could see here, 5.8 to 2.5. This tells you that the valuation is rich. What's not rich has been the dividend stocks, the companies that are boring and just, increasing dividends for years upon years, strong, great companies, and frankly, good solid stocks have not gotten the love this year. As you could see, the ones with the lowest yield or no yield have done the best, whereas the companies with higher dividend yields have not participated very much. So value has been underperforming in 2023 after outperforming in 2022. So where are we finding opportunities? That was a good lead-in. Value over growth still, right? So we still see value as being extremely attractive at these current levels. Here you'll see the lowest valuation at 11x versus the highest valuation, 29x. Valuations matter, guys. It's really important, especially now when you no longer have Tina. You know who Tina is or was. Tina was, there's no other alternative to stocks because everything else was 0%, near zero. Just a couple of years ago, the 10-year Treasury was less than 1%. So you could just figure out what's going on here. You could get cash now and get 5%, riskless. So you say to yourself, okay, well, with that kind of comparison, it's hard to make the leap of faith to high-priced stocks because you have an alternative, right? There's something that's competitive to stocks, and that could be cash, right? Especially at the current rates. Commodities or real assets, we believe, are more attractive than paper assets or stocks. And here you'll see what we think is a new bull market, if you will. Some say super cycle to commodity prices. And a lot of that has to do with the fact that for 15, 20 years, we did not invest in the supply of said commodities. And when you don't invest in the supply, you cannot get to, therefore you're upside down, right? You have demand that's now going higher because of electric vehicle demand, electrification themes, and yet you don't have a supply so prices are going to go higher. That's just 101 economics. We think small caps are attractive with the caveat of selectivity. So we're not buying the indexes, right? We're not just going into indexes and passively investing. Or I should say we're doing that, but to a lesser amount. We are now being very much more focused on active management, the selectivity, doing the homework, researching the companies, having the themes laid out, stress testing those themes, stress testing those companies, going on the actual earnings calls to make sure things are going the right way. That's what's going to win these days. Because again, we're no longer in a zero interest rate environment. International is also cheap. And this is a great slide that shows you how cheap they are. This is the ACWI, that's the All Country World Index ex-US. So US out, everything else in, 13 times PE for the 20-year average versus the S&P at 15.5. S&P now 18. ACWI ex-US 12.4. Cheap. We also, and we talked about it a moment ago, active management. This slide shows you, last year was the first in many years where active managers outperformed, where you had a vision or had a strategy, and you deployed your strategy, and it worked because you did the homework and you found the positions or indices, or I should say sectors that were opportunistic. That's different than the actual benchmark. That's called active share. When you're investing in the benchmark, you're passive, right? When you're looking at outside the benchmark, active share. It requires a bit of selectivity and a lot more homework, but it's beginning to pay off. And I think we're going to see a period of time where more active managers outperform. I always go back to the water infrastructure slide. It's an area that we feel very strongly about. Water is a requirement to life and to business and to agriculture, and yet we have reduction of supply there dramatically. And so we've been talking about the water sector for some time: pipes, pumps, valves, utilities, desalination, metering, the whole ball of wax, so to speak. And we see a lot of money coming into water and water infrastructure, which is going to buoy those stocks going forward for a while to come. And they're not so overpriced to start. So it's not like we're going into an aggressively priced sector. Okay, so they laid out for you, hopefully, what has happened thus far this year with the market jumping over the last 4 or 5 months, and why we think that the next few months will be a little bit more difficult. The concentration in the market, the valuations in the market, inflation being sticky, and interest rates going higher all lead to caution. And what we mean by caution is that we don't go all in or all out. We're going to tweak around the edges. We're going to reduce exposure. We're going to find those positions, as we've mentioned, international commodities, real assets, and the like, that we feel are priced more constructively and more attractively for our clients. We always have to ask ourselves, what can go wrong? Because again, as a fiduciary, we're watching our clients' capital and their plans and their forward retirement dreams. And so we need to be careful on how we allocate capital. This is not a game. This is not some kind of roll of the dice. This is a profession that requires careful analysis, daily analysis, doing the work. So some basic tenets that should never be ignored. What is wealth management? And we've talked about this before in various different videos, but essentially we break it down into 3 components. The first component, investment consulting. In order to be a good wealth manager, in our view, you have to understand global finance, analysis, economics. You've got to do the work. You got to study. You got to be reading up constantly to keep apprised of what's going on and what's changing. That's just basic. That's required. You cannot do this job, this profession, if you don't put the effort in on the investment consulting side. But that's not it. That's not all of it. There's a second piece, and that's planning. And we're blessed to have a great team of folks with us at ALINE Wealth that do that planning with us, that help us figure out a client's financial plan, retirement cash flow, estate plan, etc. Legacy plan. Perhaps they're philanthropic and they want to make sure they have a legacy to pass on to their families, or a value-based portfolio. This is an important component of wealth management. But that's not all. There's a third one, and we call that proactive empathy. Essentially, we're saying that you want to be proactively caring about our clients. That's it. Responsive, communicative. We want to be there for them. We want to be respectful of them. We want to understand what makes them tick and what's the most important thing to them. And we want to respect that. And we want to be care. We want to care. We do care. And I think that sets us apart, because it's really those three pieces that really come together to make wealth management what it is. But again, the analysis part is critical. Studying and reading, being independent, attending conferences, identifying sustainable themes like electrification and water and cybersecurity. These are things that we're working on, and it makes a difference to our clients. So thank you. Thank you for your time and for your vote of confidence. We're here to serve. Feel free to give us a shout out at ALINE at alinewealth.com. And we're here to guide you through what might be a choppy waters over the course of the next few months. You can rely upon us to be here for you always. Thanks very much. Have a great summer.